Hi guys, this is Siabonga from Millionaire's Journey. We are continuing with our trading course, and thank you for being part of this course. So yesterday we covered topics. We were talking about brokers. So we talked about what is a broker. We explained what is a broker. We mentioned types of brokers. We also explained how brokers make money. And then we talked about advantages and disadvantages of using these types of brokers. And then we further explained the things that you need before you open a real trading account. So today we'll be covering topics like pips, leverage, and time frame. So let's continue with the with this video and get to understand what is a pip, what is leverage, and what is time frame. So what is a pip? A pip measures the amount of change in the exchange rate for a currency pair, and it is calculated using the last decimal point. For a trader to say I made 40 pips on the trade, for instance, means that a trader profited by 40 pips. The actual cash amount this represents depend on the pip value. So if you made 40 pips, though if one pip is equals to $1, it means you made $40 depending on the pip value. If one pip is equals to 0.50 cents, it means you made $20 depending on the pip value. So if you made 40 pips and one pip is equals to $1, that means you have made $40 that day. A pip is the smallest unit that can be traded in forex. So a pip is the smallest unit that we can trade. In forex, you are not trading this entire amount. You are trading the smallest unit that you can trade. Those small movements, that's what we are trading. If a Euro USD move from 1,1050 to 1,1051, that means a Euro USD raised in value by just one pip, because it moved from 50 to 51, right? So a pip is the smallest value that we can trade. So you now know that what does it mean when a trader said they made 40 pips, and how it works. So let's continue and move to this one and explain what is leverage. Leverage is the use of borrowed money to invest in a currency pair. By borrowing money from a broker, investors can trade large position in currency. So leverage is the use of borrowed money. Leverage magnifies the returns from movement in currency's exchange rate. Leverage 1:500 forex brokers. If broker offers you 1:500 leverage, this means that for every $1 of their capital, traders receive 500 to trade with. So if a broker says your leverage is 1:500, it means for each and every $1, you can trade up to $500. It is agreed that 1 to 100 to 1 is 200 is the best forex leverage. Remember, the higher the leverage, the higher the risk. So if you are using high leverage, you are in high risk of losing a lot of money. Leverage of 1 to 100 means that with $500 in the account, the trader has $50,000 of credit funds provided by the broker to open trades. 1 is to 100 leverage is the best leverage to use in forex trading. So when you are opening a trading account, when you are asked on leverage, choose 1 is to 100. Basically, the more leverage you are, the higher the risk of your position. So if you are using 1 to 500 and I'm using 1 to 100 and the trade goes against us, you will lose more than what I will lose. A decrease of few pips means losing all your money in your account. Leverage is using borrowed money to increase returns on investment. If the return on the total value invested in a currency is higher than the interest you pay on borrowed funds, you can make significant profit. That's like 150% return. So leverage can work for you. It can also work against you. I will post more notes on our Google Classroom, so please read carefully and just take notes. Know these things, because on these videos I'm just doing touch-ups, I'm just cleaning there and there. A lot is explained and discussed in our Google Classroom, also our WhatsApp group, right? So let's continue. So we are moving to time frame. Time frame, explain. What is a time frame? Forex trading time frames are commonly classified as long-term, medium-term, and short-term. Traders have the option of incorporating all three, or simply using one longer or one shorter time frame when analyzing potential trades. So forex trading time frames: for long term, we have daily and weekly. This is for position traders. So long term, you remember types of traders: we have position trader, we have swing, we have day trader, we have a scalper. All these traders are using a different time frame. They are not using the same time frame. So long term traders use daily and weekly position traders. So medium term traders, swing traders, those who stay in trades for 2 days or 5 days, they use daily and the 4-hour chart when they are analyzing the market. Short term traders, they use 4-hour and hour. Those are the day traders, the people that close the trades at the end of the day. They don't go to bed with running trades. Then we have the scalper. The scalper uses 1 hour and 15 minutes. So I will explain what does it mean by 1 hour, what does it mean by 4 hour, what does it mean by daily. There are numerous types of time frames, but the above mentioned are the most common through different platforms. So we have many types of time frame, but these are the most common, or they are common in a lot of trading platforms, right? So let me further explain this. On your platform, you will find M1, which means 1 minute. You have M5, which means 5 minutes. M15, it means 15 minutes. M30, it means 30 minutes. Then you find H1, that means hour. H4, 4 hour. Then you find D1, that means day 1. Week 1, that means the W1 means weekly. Then we have MN, which means monthly. The time frame label indicate the amount of one candle to the time frame label indicates the amount of time one candles. So if you are on a 1 minute time frame chart, it means each and every candlestick represent 1 minute on the chart, right? So this is where you choose your chart. Remember, this is the chart, right? This is where you choose your time frame. So if you are on a 1 minute, it means this candlestick means 1 minute. This one represents 1 minute. This one represents 1 minute. They all represent 1 minute. But if you move to 1 hour, that means each and every candlestick that you see on that 1 hour chart represent 1 hour. So if you are looking at this candlestick, you are seeing what the market was doing at this hour, right? So as you can see here on the chart, we have the movement, which means as we are on the 1 hour chart, each and every candlestick here represents 1 hour. 1 hour. Same applies when you move to a daily. Each and every candlestick represents daily. So if you are looking at the daily chart, it means this candlestick represents a daily. It represents the whole day, right? So as you can see, I wrote here on 1 hour. Each candle on the chart corresponds to 1 hour. You see, it corresponds to 1 hour. So if you're opening 1 minute chart, it means each and every candle you see represents 1 minute. If you're opening a 15 minutes chart, same. Each and every candle represents 15 minutes of information. So I hope you understood this concept. I will be posting more information in our classroom as usual, and you can get to ask questions, and I will re-explain where you didn't understand. We are discussing these things. We will discuss these things. Wherever you don't understand, just feel free to inbox me and ask me. So thank you. We will meet on the other video. Sharp.